This data visualization tracks two identical 22-year-olds. They work the exact same entry-level job in the same city with the exact same starting bank balance of $1,140 and an incoming salary of $1,847 after taxes. People generally assume wealth is generated by landing a massive tech salary, hitting a lottery ticket investment, or enduring extreme deprivation. The math shows otherwise. Let's look at Path A, the builder. They immediately build a quiet system. Before they even see the money leave their checking account, $200 is automatically routed into a Roth IRA. To make the numbers work, they keep their fixed costs artificially tight by splitting a small apartment with two roommates. Path B, the spender, chooses immediate absorption. They lock into a 72-month loan for a car they need, but choose an optional, expensive trim level. They also secure their own space by renting a private one-bedroom apartment.
The mathematical distance between starting a wealth engine and starting a debt engine is incredibly small at first. In month one, it's exactly $187 redirected from consumption to investment. Those tiny, seemingly insignificant mathematical redirections in your early 20s lay the foundation for a massive chronological divergence later in life. 2 years pass. Both subjects turn 24 and receive the exact same $2,100 salary raise. Path A refuses to upgrade their lifestyle. Instead, they route the new capital into an emergency fund in a high-yield savings account. They also optimize their existing investments by shifting into a total market index fund, specifically hunting down a microscopic 0.03% expense ratio to keep more of their capital intact. Path B lets the exact same raise trigger lifestyle creep. The surplus is quickly absorbed by a more expensive apartment building with a gym.
They also buy a $1,400 couch on a zero-interest promotional plan, quietly accruing retroactive debt when they miss the fine print on the 12-month limit. This chart captures our first milestone at age 24. Path A's net worth extends outward, securing $14,300. Path B's net worth plunges backward, dragged down by debt to negative $22,860. A salary raise does not automatically build wealth. It simply acts as an accelerant, feeding whatever machinery is already in place to either amplify your investments or deepen your debt. By age 27, Path A shifts from saving capital to deploying it. Their discipline in preserving cash and building an emergency fund gives them the exact amount needed to purchase a duplex 3 hours away in a secondary real estate market. This flow diagram illustrates their mathematical leverage. Path A locks in a $21,500 down payment. That static block of capital converts into a physical asset that generates an entirely new income stream, $614 of net cash flow, returning month after month. Path B, at age 27, is steadily accumulating recurring, depreciating liabilities. They carry rolled-over credit card debt from a Cancun vacation, trap themselves in a $421 monthly lease for a new car, and bleed cash through layered subscription services they rarely open. They also make a critical error at work. They open a 401k but contribute only 2% of their salary, while their employer offers a 4% match. That inaction leaves over $1,000 of free capital completely unclaimed every year. The late 20s are defined by the conversion of capital. Path A converts cash into assets that buy future time, while Path B converts cash into obligations that steal future time. Around age 30, both systems are hit by inevitable life crises. Path B faces a breakup, leaving them stranded with a sudden, unaffordable $1,580 individual rent burden. Path A receives a call from their rental property. A water heater violently failed and requires $780 immediately. Path B has no safety net. To survive the month, they are forced to cash out $4,000 from their small 401k. They swallow a 10% early withdrawal penalty and heavy taxes, netting only a fraction of their money while putting the rest of their emergency on a credit card. Path A absorbs their shock seamlessly. The 10% maintenance reserve they pre-funded from their rental income covers the water heater in full. Their primary compounding investments remain completely untouched. Looking at the midpoint gap at age 30, the divergence is severe. Path A's net worth arcs smoothly upward to $134,000. Path B's line stutters and flatlines near zero, ending at a fragile $14,000. They have earned roughly the same income for 8 years. Lacking a financial buffer forces you to cannibalize your own future wealth to solve present-day emergencies. It permanently interrupts the compounding process. We arrive at the final audit at age 40. Path B holds a net worth of roughly $58,700, almost all of it locked in a 401k they cannot touch for decades. They operate on razor-thin margins and pay the minimum on a credit card balance that will take 11 years to clear. This dashboard shows Path A's contrasting reality. Their net worth is exceeding $1,068,000, with equity across 4 properties generating over $2,700 in passive monthly income. The gap between these identical starting points surpasses $1 million. And it was not caused by a higher salary, a stroke of luck, or extreme heroism. It was caused strictly by early, relentless repetition. Path A built this wealth to buy optionality. Their investment machinery now produces enough cash flow to grant them the freedom to walk away from a required salary entirely. Financial systems always compound, whether they are building systems or spending systems. The massive outcomes you experience at 40 are dictated by the microscopic redirections you choose to make at 22.